Hello and Assalamu alaikum. This is Dishan Hassan, a trainer of finance reporting. In this video, we will discuss the scenario number one from March June 2021 exams. Okay, so firstly, here is the as you can see in front of you that we have screen. I'm scrolling up to the scenario one. So firstly, you can see that there is the extracts of statement of profit or loss for the year ended 30th September 2000 and then there is an extract of statement of financial position as at 30th September 2007. Then we move down, we can see the notes, the adjustments we have to do done in doing the question, and then we have the requirements. First requirement is related to which saying adjust the relevant extracts from Dove Company's financial statements to apply the same accounting policies as Cook Company and recalculate Dove Company's ratios provided in the note 5. We will get 6 marks for it. Okay. Then you can see that we have to use this table to answer the part A, okay, and so on. Now, let us move to the scenario. Okay, the scenario is saying pastry company is considering the acquisition of the subsidiary in catering industry. Okay, and two companies have been identified as potential acquisition and extracts from the financial statement of Cook Company and Dove Company have reproduced below. Okay, we have statement of profit or loss for the year ended 30th September 2007. You can see revenue in front of you, cost of sales, gross profit, operating expenses, finance cost, profit before tax, income tax, profit for the year. Right, 21,500, 16,300 is the revenue for Cook and Dove Company. Then cost of sales, we can see 14,545, 8,350. Then we have gross profit, uh, 14,545 and 8,350. Gross profit 6,955 and 7,950. Then operating expenses 1,940 and 4,725. Finance cost 650 and 200. Profit before tax 4,365 and 3,025. Income tax 1,320 and 780. Profit for the year 3,045 and 2,245. Same way we have the extracts of non-current assets doubled 22,250 and 68,500. Equity is 1,000 and 1,000 for both revaluation surplus, none for the Cook Company and 30,000 for the Dove Company. Retain earning 18,310 and 2,600. Finally, we have non-current liabilities, loan note 7,300 and 5,200. Now let us look at the notes. Okay, so both companies are owner managed. Dove Company operate from expensive city center premises selling to local business and public company. Cook Company is large wholesaler selling of the chains of coffee shop. Cook Company operates from a number of low cost production facilities. Okay, so nothing to adjust from the note 1, then note 2. 1st October 2000, Dove Company revaluated properties for the first time, resulting in gain of 30 million. Okay. The properties had a remaining useful life of 30 years at 1st October 2006. Act 6, the company does not make a transfer from the revaluation surplus in respect of excess depreciation. Co company uses a cost model to account for its properties. The company and co company charge all depreciation expenses to operating expenses. Okay. Cook Company charges the amortization of its research and development to cost of sales, whereas Dove Company charges the same cost to operating expenses. These costs amounted to 1.2 million for Cook Company and 2.5 million for Dove Company. Right. So, firstly, what we will do, I'm moving my Excel sheet bit this side. Okay. Now, what is the question name? Pastry Company. A part adjusted financial statement extracts and ratios for the company. First heading as per question, I am writing in form short, then adjustment, and then adjusted. So these are the headings. Okay, just a second, I'm just adjusting it over here. Okay, now firstly, statement of profit and loss. Do you find anything regarding the revenue? See, in note 4, it's saying notes to the financial statement show that the company paid its direct total salaries of 110,000, whereas the company paid its director total salaries of 560. The following ratios have been correctly calculated in respect of co-company and the company for the year ended 30th September X5. Okay. Uh, for revenue, there is no change, no adjustment required. No adjustment required, so it's 16,300. Okay, just a second. I want to look at just a second, just a second. Okay, 16,300. No adjustment. So finally adjusted is 16,300. Back, cost of sales. What was before adjustment? As we have noticed, it was 83,500. 8,350. Is there any adjustment? Yes, we have to add 2,500 for adjusted, but it will be 10,850. So what will be our gross profit? Is equal to sum bracket open this minus this 7950 is equal to sum 16,300 minus 10,850. We get 5,450. Now operating expenses. Expenses. What was that before it? Let us go back and see. Operating expenses were 4725 of Dove company. Remember, we have to just do the adjustment of Dove company 4725. Any adjustment related to the operating expenses? Uh, Go back to the notes. Okay, on 1st October, company revalued first time, gain 30 million. Properties had a remaining useful life of 30 years. The company does not make a transfer from revaluation in respect of company uses the cost model. It's not related. Charge all depreciations to its operating expenses. Okay, so anything from the note 4 notes show that the prepaid directors and that. Anything else? No. Right now, there will be an adjustment of 1000 over here in the operating expenses. What the adjustment? The adjustment of 1000 related to what? It's related to the excess depreciation. It had, as a asset was depreciated, had a revalued amount of 30,000 and the remaining useful life was 30 years. So 30, I'm taking millions as a thousand, right? So 30,000 divided by 30, that will be 1,000 excess depreciation, right? So what I will do is equal to sum 4725 minus 1,3725. All right, will be the remaining amount, the adjustment related to it. Now, next. Uh, Also, one more adjustment we will do over here is minus 2,500. Now, you might be wondering that for what we are deducting 2,500. I will take it like this, 2,500 over here, and then I will adjust. Let me explain 2,500. Okay, 1,000 related to, you know, excess depreciation, whereas minus 2,500 is actually what, as you can see over here, it's related to, well, let me show you first. It's related to amortization of research and development. And you can see over here, let me uh, mark it for you as well. Here, oh, don't do that. Yeah. Here, you can see, right? 2,500. I'm taking as 2,500 over here. So is equal to 3725 minus 2500. What I will get? 1225, right? So here are the adjustments of operating profits. So just a second over here. 5450 and what we will get now. All right, let me show you a thing. Might be you have made this mistake in the exam. So that's why I'm just to identify you, I did like this earlier. Now I'm correcting it to show you a correct way. Okay, so what's the scenario over here? You can see operating expenses 4725, right? Now come back to the scenario over here. Adjustment three. Cook company charges amortization to its research and development to cost of sales, whereas Dove company charges the same cost to operating expenses. So if you are planning for the acquisition, the treatment should be the same. So this cost amounted to 1.2 million for Cook company and 2.5 million for Dove company, right? And which related to actually what? One related to as I told you, excess depreciation, and 2500 related to what? Um, Related to amortization, right? So we will take the next net effect of both, and we will get over here 1225 as you can see, right? So what we will do, we will take the net effect of 1225 over here, and our answer will be is equal to sum 5450 minus 1225, 4225 here, and here is equal to 7950 minus 4725, 3225, and the profit from we get the profit from operations. Okay, OP means operations. Now, as for FP related, here revaluation need the adjustment, as you can see 68,500. Then they already uh, you know included the revaluation. Now if we and we also did, right? So at one end from those company we will deduct the revaluation, so 30,000 over here and is equal to this minus this. In Dove company accounts it will be 38,500, but we will add 1,000 of excess depreciation because we already deduct the excess depreciation now and the company account we have to include it. So 38,500 plus 1,000 will get 39,500. Now no adjustment for equity shares. So it will be 1,000 and non-adjusted and adjusted. Revaluation surplus uh, as per question it was 30,000, right? We already included this, so they should not include it in their accounts. 30,000 minus 30,000, it will gonna be some this to this. Zero, right? And retain earning 2,600 it was, and 1,000 over here. So in retain earning, why we are including the retain earning? Uh, as I discussed, that depreciation would reduce 1 million from making expenses, operating expenses, and profit from operation 4,225,000. So retain earning would increase by 1,000 to 3,600. Remember that I'm taking million as a thousand, right? So 1,000 over here, it's gonna be is equal to some this to this 3,600 as we remove the revaluation of 30 million. See, if the company accounted for amortization cost of sales, I'm repeating it for you. Cost of sales would increase by 2.5 million, making profit of 5,450,000. Expenses would decrease by 2.5 million, but the profit operation would remain at 4,550,000. So here our it's done almost because finally we have loan notes which will be the same 5,200 and 5,200. Done and dusted. The first requirement, I hope it's clear to you. Now, then we have requirement B. Based on these adjustments of accounting ratios, compare the performance of the two companies. Your answer should comment on the difficulties of making a purchase decision based on the extracts of the financial statement and the information provided in note 1 to 5. We already look at them. So what now we will do, will open the our another. Now we will open the worksheet and draft the answer for this part of the question. Okay. So what will say? Cook company may be a slightly larger company having made more sales and profits during the year. Initially, it appears that Dove Company makes a significantly higher margin than Coke. Coke 48.8% compared to 32.3%, which suggests that it is much more profitable to sell as a retailer than wholesale. However, this is misleading as the higher gross profit margin is largely due to the accounting policy of where amortization is charged. Is charged once the figures are adjusted. Once the figure are adjusted to make two companies comparable and both gross profit margin are much closer, 33.4% and 32.3%. Even with this adjustment, Dove company making a higher gross profit margin, suggesting that the relatively high cost properties are still producing good return. While looking at the operating profit margin, it appears that Coke company makes a significantly higher margin, suggesting a greater cost control, 23.3% compared to 19.8%. Once the adjustment for the different accounting policy, adjustment for accounting policies, accounting policies are taken into account. It can be seen that the margins are much more comparable, 23.3% and 25.9%. While at the other end, operating expenses information is not enough to draw a conclusion on it. The one thing which can be noted is the higher payment of salaries in Dove company compared to Cook company, as both companies are owner managed. It may be that Cook companies management are taking a lower level of salaries in order to show increase profits. Mm. Alternatively, it could be that Dove company management are taking salaries which are too high at the expense of growth of the business. The low level of retained earning suggests that Dove company owners may not leave much money in the business for growing the company. Now let us discuss on ROCE. The ROCE was given in the scenario. Let me show you over here. Is here it is. ROCE 18.8% of Cook company and 8.3 of Dove company, right? So where it is, yeah, here. ROCE. Now let's discuss on it. When looking at the ROCE of Both companies, the initial calculation show that Cook company is making a much more impressive return from its long-term funding, that is 89.8% compared to 8.3%. This is completely reversed when the revaluation surplus is removed from Dove Company figures, as Dove Company makes a return of almost twice that of Cook Company, which is 18.8% at 43.1%. Okay, this return is not due to high operating profits, as the margins of the two companies are similar, with Dove Company actually making lower profits from operations. The reason for the high ROCE growth is that Dove Company has a much better asset turnover than Cook Company. This is not because Dove Company is generating more sales, as these are lower than Cook Company. The reason is that Dove Company has a significantly lower equity balance, and due to having extremely low retained earning than Cook Company, and then difficulties what I'll say over here. Without it would be difficult without examining the market value of book companies' properties. It will be difficult to assess which company is likely to cost more to purchase. Also, uh, basing any investment decision on single year financial statements is difficult, right? Finally, my conclusion, both companies seems to be profitable. Uh, Looking at prior years financial statements will help take decisions clearly. That's it. That's how you need to answer the this part of the question. Just look at the each of the results of the adjustment and ratios, uh, compare them with each other, and then comment on it. Either it is good or bad, it's getting better, it's getting worse, and then your conclude and one line conclusion on that particular ratio, like that, and finally the difficulties and conclusion, right? So that's how you should answer this part of the question. And overall, I hope you get the exam technique that how to uh, do both part of the questions. So I'll see you in the next question, the next week.